things have turned out quite positive for the first hour and a half of trade. As they did yesterday with the inflation figure that we reported, that went down is a big relief. Robert Pryor, Wandersford of Credit Suisse, joins in to talk about that. Robert, that was a big shot in the arm for people tracking the macros. What did you make of it, and more importantly, does it have follow through, and do you think we can deliver this kind of muted inflation performance for the next few months?
Yes, I think we probably can. I mean, the number itself was obviously better than expected. I think it's the fifth downside surprise relative to consensus forecasts in the last 6 months. So, you know, this is not a one-off. This is a trend. It is the lowest headline number since November 2009. And I think also if we look at core WPI and take a seasonal adjustment and look at it on a sequential basis, then there's really nothing going on there at all. 3 month on 3 month, it's running at annualized 0.2%. So there's no underlying WPI pressures there whatsoever right now, as far as we can see. And that, I think, does set us up, you know, nicely for that May the 3rd meeting. The only thing I think that could throw a spanner in the works is, you know, if the trade deficit number is poor. But I don't think that's going to happen. I think the trade deficit actually is going to improve again, and will actually, looking further afield, will continue to improve. Obviously, the drop in the oil price and the gold price is helpful in that respect, but that's not the only factor.
Robert, hi, good morning. Good to see you in on the show. The other breather for macro watchers has been the huge slide that we've seen in gold and crude prices and the impact it would have on the current account deficit. In your mind, how much of a net saving would this result in the current account deficit itself?
Well, if the oil price is down about 10%, I guess, from its recent levels, if that's sustained over the next 12 months, then my estimate is that net exports of oil are reduced by about 10 billion, or just over 10 billion US dollars. That's about 0.5% of GDP. So it's not insignificant by any means. But actually, gold could be even more important. Obviously, it's been a bigger fall in the gold price, about 25%. Volumes have really come off, according to the data we had yesterday for the March quarter. They were down something like, I think, 25% year on year. Put those two things together, then you could be looking at a 20 billion improvement from gold. Now, all of this assumes that the fall in oil prices and the fall in gold prices doesn't, you know, over the longer term, lead to an increase in demand for those two items. So I think the best scenario here we could be looking at is a reduction in the trade deficit worth something like 30 billion US dollars from those price moves, equivalent to about 1.5% of GDP. Not bad, but as I say, not the only factor. I think the lagged effects of the weak rupee are finally coming through. Statistically, when we model this, it does take 18 months or so to have an impact. It is now just over 18 months. The last couple of trade numbers have shown exports rising. I think we're going to see, you know, quite possibly a fairly dramatic improvement in the trade and current account position going forward. I certainly think it's over the worst now.
How would the Reserve Bank tot all this up, Robert? Because in the past they have indicated their concern not just about inflation, but the way things have been progressing on the current account deficit front. When they meet in May, what would you expect them to do and say?
Well, I mean, Dr. Subarao has shown his cautious nature, I guess, over the last year, 18 months. I mean, he was obviously pretty slow in cutting interest rates, and, you know, he wanted to see inflation coming down. He no doubt wants to see the current account deficit improve, and you know, he's not going to, I don't think, cut dramatically until he sees evidence, firm evidence, that the current account deficit is improving. So my guess is that we get 25 basis points at the May meeting, and that's followed perhaps by another 25 basis points at the intra-quarter meeting as well. For a year now, we've had a view that the repo rate would bottom at 6.75%. We still hold that view, and perhaps think that maybe, you know, it could be lower than 6.75%, the eventual bottom.
The only chink in the armor yesterday, Robert, was the upward revision that we saw in the January numbers. Do you think this, along with the higher CPI numbers, will prevent a larger rate cut or a larger easing cycle that the RBI might have planned earlier?
Well, I'm not sure the RBI has planned a large easing cycle. I mean, I think, as I say, it's been a very cautious approach, and I think Subaru hasn't been planning a significant reduction. He's been waiting and hoping for inflation to come down. The upward revision, is not a massive surprise. We see this virtually every month. The CPI number, I think, is perhaps more important. It came down, but it's still 10.4%. That's still uncomfortable. I think what it means is that we don't get 50 basis points at the meeting. I think it means we get 25 basis points. We wait for another one or two sets of data, which I think will show further falls in inflation, and then we get another cut. So it's all quite reactive, I think, from the central bank. In a way, it's understandable because inflation is high, and he does want to see it come down. But it is reactive rather than proactive, I think, is the best way of describing it.
Ground checks, though, still seem to indicate that industrial activity is quite sluggish, Robert. We're going through a fairly difficult earnings season in terms of what corporate India is reporting. How far would you push back any significant growth recovery? Because that's really what will get things moving for markets here.
Well, one thing I want to note on that industrial production number is the capital goods figure. Now, of course, I'm sure lots of people on this program have talked about that capital goods number, 9.5%. And largely dismissed it as an aberration, but it is very volatile. We know that. But if we just smooth it, we take a 3-month moving average of that industrial production series, of the capital goods bit of the industrial production series, then it has actually been trending higher now since the middle of last year. What I think it suggests is that the pickup we saw in capex that was reported in the December quarter. Capex was reported as rising just over 6%. This improvement in capital goods production tends to support this notion that actually there is a recovery in capital investment going on. A very modest recovery from a very low level, but it has been going on now for several months. And I would be much more optimistic. I think a lot of people have written off the chances of capex recovering. I think the recovery has started, and I think it will slowly gain momentum. Beyond that, of course, the March quarter, generally government consumption, we presume, is going to be very, very weak, and that will be a big drag on GDP in the March quarter. But, to achieve a 4.8% deficit in 2013-14 seems to us doesn't require much more in the way of fiscal tightening, perhaps nothing. And therefore, that fiscal drag is going to come off quite quickly. I think the recovery is going to become increasingly evident. Certainly from the current quarter, from the June quarter.
Good speaking with you, Robert. Thanks for joining in this morning. That's the word from Credit Suisse. Expect to see some kind of affirmative action from the Reserve Bank when they meet next.